Hello and welcome back to our channel Polo Vega. Hope you've enjoyed our videos so far. Before we start with our presentation about rate of interest, we'd like to draw your attention to our disclaimer/disclosure clause. Disclaimer/disclosure. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the sixth of a series of interactive videos aimed at educating our viewers with rate of interest, bonds, yields, and yield curves. Interest rate. Interest rate is the amount a lender charges for the use of assets expressed as a percentage of the principal. The interest rate is typically expressed on an annual basis and is known as annual percentage rate if we include the other expenses incurred while borrowing the loan from the lender. A simple way of expressing interest rate is the nominal rate of interest, which just counts the interest amount without considering other expenses like service charges, agency charges, fees, etc. Interest is what you pay for borrowing money or what banks pay you for saving your money with them. Interest rate and inflation. Interest rate is a tool used by central banks and monetary policy committees to achieve economic objectives such as low unemployment, manageable inflation, sustainable growth. When the central banks decide to raise the rate of interest, it leads to a shortage of money supply, which in turn leads to a drop in investment and therefore a drop in economic activity and inflation. Opposite is the case when the central banks decide to lower the interest rate. It leads to an increase in money supply, therefore a growth in economic activity and an increase in inflation. As we've spoken on the earlier slide, one can see that once you decrease or increase the interest rates, the money supply changes in the market. So when you increase the interest rate, money supply decreases, which leads to a decrease in inflation. And the opposite happens when you decrease the interest rates, when the money supply increases, and so does inflation. Interest rate and bonds. Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are issued to borrow money. Governments use bonds to borrow money for expenses required for education, infrastructure, and other public services, or war can also create a situation where governments may need to borrow money through bonds. Four categories of bonds: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the government, and agency bonds issued by government affiliated agencies. Bonds are fixed income instruments as they give fixed interest rate or coupon rate to the bond holder, although the bonds with variable rates are common. Common characteristics of bonds. Issue price is the price at which the bond is issued and sold to the buyer. Face value is the value the bond will be worth at maturity. Coupon rate is the percentage of interest rate the issuer pays on the bond. Coupon date is the day on which the issuer pays the interest on the bond. Maturity date is the day on which the bond matures and the issuer pays the face value. Bond prices move inversely with interest rates, which means they will set at a discount with interest rate and a higher price if the interest rate goes down. Negative correlation between bond prices and interest rates makes sense as most bonds pay a fixed interest rate and they become more attractive when the interest rates fall, driving up the demand for these bonds, which leads to an increase in the price of these bonds. Conversely, when the interest rates go up, investors do not prefer the old bonds with lower interest rate, hence the demand falls, leading to a fall in the price. Zero coupon bonds are the best kind that show the inverse relationship of the bond price with interest rates until the maturity date when the bond holder receives the par value. Zero coupon bonds are issued at a discount to par value with their yields a function of the purchase price, the par value, and the time until maturity. Interest rates and yield curves. Yield curve is a line that plots yields, that is, interest rates of bonds having equal credit quality but different maturity dates. The slope of the yield curve gives an idea of future interest rates, changes, and economic activity. There are three shapes of yield curves as illustrated in the diagrams alongside, which are normal, flat, and inverted. Yield curves and their significance. Yield curves are drawn by plotting interest rates or yield on the y-axis and maturities on the x-axis. Normal curves slope upwards and show that interest rates for short-term bonds are lower than those for long-term bonds. To illustrate the foregoing, one can say that yield for 10-year Treasury bills is lower than 30-year Treasury bills. These curves are a sign of economic growth and expansion. Flat curves or humped yield curves show that short-term yields are more or less the same as long-term yields. These curves show the signs of an economic transition. Inverted curves or downward sloping curves are those where short-term bond yields are higher than long-term bond yields. These show signs of the economy going into a recession or a period of negative economic growth. Yield curve risk. Yield curve risk is a risk borne by the fixed income securities on account of change in interest rates. It shows the risk of adverse shift in interest rates for investors taking positions in fixed income instruments. Changing market yields lead to change in the price of the fixed income instrument. Changes in yield curve are based on bond risk premiums and expectations of future interest rates. On the chart alongside, we can see that the corporate bond yield curve is higher than the Treasury bond. There's a spread between the two because the investors see the corporate bonds as more riskier as compared to the Treasury bonds. Use of yield curves by investors and banks. Investors holding positions in fixed income securities can hedge yield curve risks by building portfolios that react to changes in interest rates as the yield curves on bond risk premiums and expectations of future interest rates, thus allowing the investor to predict the shift in yield curve and hence the change in bond prices with the change in interest rates. Flattening of yield curves occurs as a result of the contracting spread between the short-term and long-term bonds and indicate a slowdown in economic activity with the expectation of inflation rates and interest rates to be low for a while. Banks are reluctant to lend during such periods. Steepening of yield curves occurs when the spread between the long-term and short-term interest rates widens and the economic activity is strong, with the yields on long-term bonds rising faster than short-term bonds, or the yields on short-term bonds rising at a slower rate as compared to long-term bonds. Hence, the price of long-term bonds decrease relative to short-term bonds. During such periods, banks are willing to lend as they can borrow at low interest rates and lend at higher interest rates. Inverted yield curves occur when short-term interest rates are higher than long-term interest rates. Investors are willing to take positions in short-term bonds as they expect the interest rates to fall in future. This occurs at a time of recession or extremely weak economic growth when inflation and interest rates remain depressed for a long time. Hope you enjoyed our short video presentation on interest rates, inflation rates, bonds, their interrelationship, yield curves, their types and significance. If you enjoyed our short video presentation, then please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega. In our next video, we shall talk about currency, exchange rates, currency markets, and trading of forex as an asset class. Until then, please keep saving, keep investing, and keep getting wealthier. You may also visit us at our website www.polovega.com or contact us on our Twitter handle @polovega.